We go then to the first session where we explore a basic distinction flowing from the requirements imposed by Section 8, capital C of the Income Tax Act. 8 capital C, of course, then being that provision which governs the taxation of employees pursuant to employee share schemes. Section 8C draws a central distinction between vesting shares, which in the language of Section 8C is called unrestricted equity instruments, and non-vesting shares, which again in the language of Section 8C would be restricted equity instruments. Very broadly, an instrument will be a restricted equity instrument if it is subject to such a restriction as to impede the capacity of the holder of the shares, the equity instrument, from disposing of that instrument freely and at market value. Yeah? There is an exception here. A restriction will not be a material restriction for the purpose of Section 8C if it is imposed by law. Yeah? Okay. We are also going to be exploring a distinction between fully paid shares and partly paid shares. Now that distinction arises not from Section 8C, but from Section 40 of the Companies Act. Prior to the introduction of the new Companies Act and Section 40, if you were to issue shares other than fully paid up at the time of issue, that would be an invalid issue. Section 40 now allows for shares to be issued immediately, notwithstanding that they are as yet partly paid, and that the balance of the issue price is to be settled over time in a variety of fashions. It is not restricted to monetary installments. You can also look to future services and the provision of future benefits to the company. We'll be exploring Section 40 in some considerable detail in one of the later sessions. This notion of an unrestricted versus a restricted equity instrument again flows from Section 8C. It is again, principally a requirement that if an equity instrument is to be unrestricted, it must be freely disposable at market value. The exception again is a restriction imposed by law. Now that exception raises an interesting question under the Companies Act. If a company is to qualify as a private company, its memorandum of incorporation must, under the Companies Act, impose a restriction or restrictions upon the transfer of the shares. Yeah? The intriguing question that flows from the Companies Act of a requirement of a restriction upon the transfer of the shares is just how far can you go in restricting share transfers while still being able to say that these restrictions are imposed upon the company by law. Yeah? I take a, I think, prudent and conservative view. In my view, you are at risk of the instrument being treated as a restricted equity instrument if you go beyond the imposition of minimal restrictions upon the transfer of the shares. If you want to play it safe, you might, and this is a typical formulation, say in the MOI that the company's shares may not be transferred other than with the consent of the board, to which you then add which consent shall not unreasonably be refused. Yeah? That is perhaps the minimum restriction which you can impose on a transfer of shares while still complying with the Companies Act. If you go beyond the minimum, the argument might be you've gone too far. Yeah? This is not imposed upon you by law. Okay? So be very careful there in framing the restrictions attendant upon the transfer of the shares if you are thinking of instituting an employee share scheme and you want to issue shares on such a basis that they constitute unrestricted equity instruments. Okay. There are further requirements to be met if an instrument is to be classified as either restricted or unrestricted. Section 8C also says that, other considerations aside, an instrument, an equity instrument, will be a restricted equity instrument if the issue of the shares is subject to any condition that could result in the holder being subject to a forfeiture of ownership or a forfeiture of a right to acquire ownership otherwise than at market value. So if, for example, you impose as a condition under your employee share ownership plan that a shareholder employee shall do nothing to bring the company into disrepute, and if you do bring the company into disrepute, the company shall have the right to buy your shares at a 15% discount to your market value. Yeah? You would then, notwithstanding the free transferability of the shares, yeah, be faced with a restricted equity instrument. Okay? It will also be a restricted equity instrument, notwithstanding that it might be freely transferable, if the breach of the conditions imposed in respect of the issue of the shares extend to provisions which provide for the employee shareholder being penalized financially or in any other manner for not complying with the terms of the agreement for the acquisition of the shares. And that is not yet the entire story. It'll also be a restricted equity instrument if the employer or some other person, but then by arrangement with the employer, has undertaken at the time of the acquisition of the instrument that in the event of the instrument's market value declining below its issue price, yeah, they will nonetheless purchase or repurchase the instrument at its issue price. Okay? So you issue your shares at 100 per share. They're subject to a guarantee, if you like, to put it very loosely, that if a market value falls below the issue price, they will nonetheless be bought back or purchased at the issue price. You are dealing with a restricted equity instrument. So while the principal requirement is that the holder of the share must be able to dispose of the instrument freely and at market value, yeah, that is not the whole of it. Yeah? Okay? If there are what you might call punitive conditions, yeah, then it may still be a restricted equity instrument. If there is a flaw under the value of the shares, yeah, it may again be a restricted equity instrument. Now, under Section 8C, if an equity instrument is acquired by virtue of employment or the holding of a directorship, the holder will be taxed at marginal rates on the excess of the market value over the issue price of the share, either on the issue of the instrument, if the instrument at the time of its issue is already an unrestricted equity instrument. If the instrument at the time of its issue is not there and then an unrestricted equity instrument, then the assessment is deferred until the restrictions in question lapse. And it is then upon the lapsing of the restrictions that the assessment is raised under Section 8C. Now, it's important to appreciate that if you issue a share as an unrestricted equity instrument, and at the time of the issue of that share, the issue price is aligned with its market value, you will qualify for a nil assessment under Section 8C. Section 8C, once imposed, cannot again be imposed upon a subsequent sale of the shares. So issue an unrestricted equity instrument, align its issued price with its market value at the time, a nil assessment. On a future disposal of the shares, the holder will not be subject to tax at marginal rates. The holder will be subject to capital gains tax at the favorable effective rate of 13.2%. Okay? As regards the further relevance of this distinction between restricted and unrestricted equity instruments, there is a newly introduced provision with effect from 1 March 2014, which has some bearing on whether or not the instrument is restricted or unrestricted. Section 10(1)(k) Roman 1 Roman 2 exempts from normal tax any dividend received by or accrued to a person in respect of services rendered in respect of employment only if it is a dividend received or accrued in respect of a restricted equity instrument. Now, I need to translate that provision for you. It's drafted in obscure terms. It seems by reference to the explanatory memorandum that what SARS and Treasury intended to do was, in prescribed circumstances, to ensure that dividends paid on employee shares would be subject to normal tax. They would be subject to normal tax if the yield on the shares, the dividend payable on the shares, was linked to the individual performance of the shareholder. So if you were a star performer this year, you'd get a higher dividend. If the guy in the cubicle next year had been an underperformer, he or she might get a lesser dividend or no dividend at all. Okay? Now, I will, in the final session today, illustrate for you the kind of scheme that might be caught by this new provision. But it's important that to note that you will have your dividend treated as normal income. Not only if there is this linkage to performance, but then only if the share is not a restricted equity instrument. If the performance dividend, if you like, is paid on a restricted equity instrument, it still qualifies for the exemption under Section 10(1)(k). Okay? It'll be exempt from treatment as normal income. Okay? I must say that the drafting of this provision leaves much to be desired, and I'm uncertain as to how a court would be prepared to construe it. The difficulty with the wording is that employee shares in general, are issued in respect of employment and accordingly, in respect of services. It becomes difficult to determine under what circumstances this new provision is to apply, given that the general background to an issue of employee shares is a service relationship, an employment relationship. One divines from the explanatory memorandum, again, that you will be caught under the new provision only if there is a direct linkage between your standard of performance and the amount of the dividend distributed to you. You will never be able to have such variable dividends riding on individual performance if the company only has one class of shares. You would have to create a special class or special classes of shares. The Companies Act prescribes that within any one class of share, all the shareholders must participate pro rata in dividends declared. So you can't pay a disproportionate dividend to somebody because that person has outperformed in the given year. We'll come back to this question in the final session today. When will the issue of an unrestricted equity instrument be advantageous? Now, we've explored this in part already. It will be advantageous to issue a share as an unrestricted equity instrument if the issue price and the market value were aligned at the time of issue. Advantageous because, again, in those circumstances, you will attract a nil assessment under Section 8C, and albeit that it is a nil assessment, you are thereafter not again subject to Section 8C on an ultimate disposal of the shares. You attract capital gains tax treatment. And that rate there should have, that rate's correct. Okay. When, to the contrary, might an issue of restricted equity instruments be advantageous? Be advantageous principally if you want to issue shares at a discount to market value. You don't want to attract an immediate assessment under Section 8C, and you defer the assessment until restrictions lapsed or the shares are disposed of. As regards unrestricted equity instruments, they have an ideal application to senior executive share schemes. For senior executives, you ideally issue unrestricted equity instruments at market value. Now, employers tend to be wary of issuing shares to anyone without imposing restrictions on transfer. There is this fear that the shares might end up in the wrong hands. Now, that fear is, generally speaking, misplaced. There is a lot of truth in the old saying that a minority shareholding in a private company is not worth the paper it is written on. That is an exaggeration, but there's an element of truth. There's an element of truth because the market for a minority shareholding, a non-controlling shareholding in a company, consists principally of the company itself and the other shareholders in that company. So the chances of the shares ending up in the wrong hands are, as a practical matter, relatively remote. There are, in any event, mechanisms one can use to ensure, mechanisms one can used to ensure that if the shares do end up in the wrong hands, they can be retrieved. There are mechanisms one can use, such as a right of preemption on the part of the company and the other shareholders in the company to ensure that the company continues to be the primary market for the shares, and that you can then block a sale of shares to others. In relation to rights of preemption, you have to be careful. Your rights of preemption, and particularly then the period over which a right of preemption can be exercised, must not be such that the shares can no longer qualify as instruments which can be sold freely and at market value. If you're going to accord to the company and co-shareholders a right of preemption, for example, which is exercisable over 6 months before the shares can be sold to a third party, you are going to be placing a clearly unreasonable restriction on the transfer of the shares to the market in general. You need to be careful as to just how long that right of preemption is exercisable. If it's a month, I think that's reasonable. If it's 2 weeks, that's clearly reasonable. But be careful.